Hi, I'm Steve Breen with Prosperion Financial Advisors. In the book Thinking, Fast and Slow, the author Dan Kahneman famously describes how people are generally loss-averse when it comes to money decisions. He quotes, "Losses loom bigger than gains." Well, this is the loss aversion ratio, and it's been measured with several experiments, and it's usually in the range of 1.5 to 2.5 to 1. In other words, people are 1.5 to 2.5 times more fearful of a loss than the same emotion or greed for gain. This loss aversion can have a profound effect on how you view your portfolio, especially when it comes to stocks. Most investors claim to be unnerved by uncertainty, but really we all hate to lose money. It's one of the reasons that crash predictions and negative thinking seem to be more intelligent, make more sense, have more authority. You may have seen similar data in the past, but I think if you just look at rolling historical performance numbers, it puts things into better perspective, especially long-term perspective for investors. You can see from this chart that the daily returns of the market are more or less a 50-50 proposition. Well, since loss aversion means that losses make us feel worse than gains make us feel better by that factor of 1.5 to 2.5 to 1, this means if you check the value of your portfolio on a daily basis, you're more likely to feel terrible every day. Every good feeling you get from a gain seems to be completely wiped out by bad feelings you get from down days. However, when you lengthen the time horizon, the effects of loss aversion slowly start to fade. In the book More Than You Know, Michael Mossenben, and I know I butchered that last name, discusses how the phenomenon of loss aversion with respect to investments and time horizons work together. He describes investment decisions and loss aversions this way. Quote, "We regret losses 2 to 2.5 times more than similar sized gains. History certainly has demonstrated the longer the holding period in a financial market, the higher the probability of a positive return." He concludes, the more frequently you evaluate your portfolio, the more likely you are to see losses and hence suffer from loss aversion, almost like a syndrome. Conversely, the less frequently investors evaluate their portfolio, the more likely they are to see gains. This is what Richard Thayer termed myopic loss aversion. It's the combination of loss aversion and our tendency to look at the outcomes far too frequently. So what's an investor to do? Well, A, either follow along so closely that you become immune to the daily gyrations, or B, stop looking at the portfolio's market value so frequently. Quarterly is probably sufficient. Kahneman describes this in his research that professional risk takers in the financial markets are more tolerant of losses than non-professionals. Why? Well, because they become accustomed to the daily fluctuations. Yet even the pros can have a difficult time focusing on the correct time horizon, with increased focus on quarterly or annual performance reports versus benchmarks and peers. It takes time and experience in the markets to build up your tolerance for the correct time horizon. With the ease of access of real-time information, it's harder than ever not to look. The analogy that I like to give to investors is something that I call the throw the towel over the treadmill screen strategy. Have you ever noticed in January all the New Year's resolution runners who haven't worked out in quite a while on the treadmill seem to throw the towel over the screen on the treadmill so they can't see the time or the distance? Well, this is because when you keep looking at the screen, time seems to crawl. It can seem like you've been running forever when you're watching every second tick away. Obviously, it's pure psychological, but the trick seems to work for those who stick with it. For the same reason, the less you look, the faster time seems to go. Eventually, you can get used to it and you can remove the towel. Now, I'm not suggesting that you neglect your investments by any means. You still need to occasionally track your performance, make sure your asset allocation is in line with your risk tolerances, and periodically rebalance. Continue to make contributions on a regular basis. This less is more philosophy seems to work in almost all areas of portfolio management. Checking the value of your account is no different in this respect. If you'd like to have a conversation about the topic of loss aversion, feel free to contact us. I'm Steve Bereen of Prosperion Financial Advisors. Thank you for being a client of our firm.